Hi everyone, welcome to this week's Market Watch. My name is Hillary. Recent reports have shown that the tide of investment capital continue to flow against emerging market equities as investors flock towards developed markets like US and Japan. So has the tide changed for emerging markets? Well, we do not think that the tide has changed for emerging markets. We continue to believe in the long-term growth prospects of emerging market equities. However, we do expect weakness to remain in the short run as these economies continue to be weighed down by inflationary concerns and the prospects of interest rate hikes. Okay, before we go on to the reasons, first the facts. Emerging market equities underperformed developed market equities by 12% since November 2010. A relative pullback of emerging markets of this magnitude occurred 6 times over the last decade. Developed market equities are currently trading at a PE of 15 times, while emerging market equities are trading at 13 times. With that, emerging markets are trading at a cheaper valuation relative to developed markets. With regards to whether the tide has changed for emerging markets, we do not think that is the case, and there are 3 reasons for this. Firstly, we believe emerging markets will continue to shine in the long run on the back of positive demographics. These economies have a relatively young population, and they could gear up to change its growth model from an export-driven economy to one driven by domestic demand. Secondly, the balance sheets of these economies are stronger relative to years ago. Lastly, previous pullbacks of greater than 10% occurred during periods of collapsing global growth expectations. With no sign of a double dip in the developed economies, there's little to suggest global growth to decline. And so we continue to believe in the long-term prospects of emerging market equities. Nonetheless, we do expect weakness to remain in the short run. That's all we have for you today. Tune in next week for more Market Watch.